Hi, I'm David Stein of Money for the Rest of Us. And in this video, I answer the question, should you allow Warren Buffett to manage your money? I recently got this question from Harry, a listener to my podcast, and he says, why not go out and just buy Berkshire Hathaway stock and let Warren Buffett manage your money? You can buy shares of Berkshire Hathaway for $200 if you buy the B shares. You can just buy them and allow Warren Buffett to do it. He and Charlie Munger. Well, as a professional investment advisor, I used to manage money, and I also used to evaluate outside money managers. My team and I spent over 15 years doing that, and we focused on the people, their investment process, and their performance. So let's look at Berkshire Hathaway in that way. Let's focus on the people first. The leaders of the company that are selecting stocks and deciding whether to buy entire businesses are Warren Buffett. He's 88 years old, and Charlie Munger, who is 95. Now, in the 2018 annual letter, Buffett was really excited about the promotion, the positioning of Ajit Jain and Greg Abel to run the operating businesses of Berkshire Hathaway. But Buffett and Munger are still pretty much responsible deciding which companies are bought, particularly which stocks are bought. And when you look at an outside money manager, you're really concerned about succession plan. As the senior partners get older, how is their investment culture going to be transmitted to that next generation? Who's going to take over? In the case of Berkshire Hathaway, they've never really described that. There is no formal succession plan. So that's a risk because of the advanced age of Buffett and Munger. What about their investment process? Well, Buffett said in his 2018 annual letter, he says, let me remind you of our prime goal in the deployment of your capital, to buy ably managed businesses in whole or in part, and ultimately make those purchases at sensible prices. That's their process. They have a two-pronged approach. Sometimes they buy whole businesses, and sometimes they buy just a portion by buying 5 to 10% of the publicly traded shares. That's really Berkshire Hathaway's competitive advantage, that ability to, that two-pronged approach, to buy entire businesses or buy a portion of the stock. In terms of how they go about doing that, they describe in the 2013 annual letter of modeling out 5 years worth of earnings. If they can estimate earnings over a 5-year period, get a high level of confidence at, and then compare that to the price, and if the price is reasonable, then they'll purchase the stock. Not always easy to do, but they've been very, very skilled at it. One of the challenges that Berkshire Hathaway faces is they have over $100 billion in cash. That's a lot of money to put to work. Now, some of that's working capital, but they're always looking for businesses that they can buy. And Buffett's been frustrated, and he mentioned this in the 2018 letter, the inability to find these businesses at a reasonable price. When a money manager has too much capital and has a hard time getting it to work, then that's a challenge. And that's one of the red flags with Berkshire Hathaway. They have a lot of money and not been able to deploy all of it. And perhaps at times when they've made mistakes. Most recently, they purchased in 2013, they purchased H.J. Heinz. This is a food producer, food manufacturer. They sell food products, basically brands in the grocery store. They bought in 2013. He was really excited, Buffett, about this particular purchase in 2013. Thought the company would be around for over 100 years, a long-term holding. And then in 2015, they merged H.J. Heinz with Kraft. Just a couple of weeks ago, Kraft Heinz announced that they were taking a massive write-down. They're being investigated by the SEC regarding their accounting policies, and the stock fell 30%. Berkshire Hathaway owns 26% of Kraft Heinz. They also had to take a big write-down. Buffett says we flat out overpaid for Kraft. They didn't see the competitive advantage that Costco had in terms of some of their in-store brands that were taking market share away from Kraft Heinz. Buffett says just because you overpay for a company doesn't mean the company's going to earn more. And so all money managers make mistakes, and this was a particular mistake that Buffett and Munger made. And you have to wonder, is that going to be more of a challenge going forward because they have so much capital to invest? The final thing we want to look at is performance. And performance for Berkshire Hathaway has been absolutely incredible. In their annual report, the 2018 annual report, on page 2, there's a table that shows the performance every year relative to the S&P 500. It goes back to 1964, and the annualized return for Berkshire Hathaway was 20.5% versus 9.7% annualized for the S&P 500. That is incredible performance. But we want to look at more recent periods when Berkshire Hathaway had much more capital under management. Over the past 5 years, they've actually done pretty well. They've returned 11.4% versus 8.5% for the S&P 500. That's annualized. On the 10-year basis, they've actually underperformed, though. They've returned 12.2% versus 13.1% annualized for the S&P 500. On a 20-year basis, they've outperformed by 2%. Now, that was through 2018. In 2019, things have been more difficult. Berkshire Hathaway is about flat in terms of performance, while the S&P 500 is up 12%. And as a result, on a 15-year basis, Berkshire Hathaway is now trailing the S&P 500. Now, hopefully performance will rebound, but when you look at the performance, it's not as astounding as it was in the past. It's been more of a challenge as they've gotten bigger, and that's very typical for money managers. As they get more capital, it becomes more difficult to outperform. So would I hire Berkshire Hathaway to manage my money? Probably not. What concerns me is the lack of a succession plan. Munger and Buffett are brilliant investors, but they are advanced in their age, and there isn't really a team to take over in terms of buying the stocks. The operating businesses look fine. They certainly are in great hands with Jane and Abel. So that's one concern. The second is just the sheer amount of capital they have to deploy, which made it more difficult to deliver the level of outperformance that they've had in the past. Hey, you can learn more about Berkshire Hathaway and the analysis of how to evaluate money managers in episode 242 of my podcast. I go into much more detail. And hey, if you like this video, go ahead and like it. If you have any questions, put those below, and please subscribe to my channel. Thanks.